Many investors are absolutely confident that we're going to have a recession this year in 2026, given the massive rise in oil prices up to $91 per barrel, and it could potentially go much, much higher. And you combine it with all the private credit stuff, with very recently BlackRock frozen $1.2 billion in withdrawals. And there's a lot of concerns. We could have a financial crisis, we could have a lot of inflation, or even a recession due to all the geopolitical events and the private credit stuff that are happening in the market. But this is really an amazing tweet on X. And it says, what do you notice here? With the biggest sellers on Substack being bearish people, selling fear, because fear sells. Fear gets a lot of attention. But fear can also be exaggerated and it could be misunderstood. And I believe it's also exaggerated in this case. I don't believe we're going to have a recession or something as bad as a lot of people are expecting. I'm going to tell you why and give you my thesis in today's video. Now, the first one is that a rapidly rising oil price tends to cause a recession. This is 100% true. But if you look at the oil price adjusted for inflation, meaning in real term, this is where we are today. Oil has a long way up to go before we get any kind of recessionary fears, in my opinion. But there's another reason why I believe this is not going to happen this time, is if you look at crude oil, which is up 41%, versus the energy stocks, they're only up 5%. So crude oil is going up a lot, but the energy stocks that benefit from crude oil aren't going up. Many people are confused on why this is happening. Well, this tends to happen when the market believes that this oil price is not sustainable enough for those companies to make massive profit on it. So they believe it's a short-term event that's going to revert down much, much sooner than people are expecting. Now, to be fair, oil stocks have kind of priced it in. They kind of anticipated this event, but recent price action tells me that many investors believe it's not going to last as long as other people believe. But even if it does go up and it lasts a little while and oil is much, much higher and natural gas is much, much higher, that doesn't mean that the stock market is going to crash. The stock market is not the economy. We had many kind of attacks and wars before, and the market went up when people were expecting the stock market to go down. And this is a study of the S&P 500 around geopolitical risks and events with higher oil prices. 4 out of 6 times the S&P was higher. The S&P went up. Only 2 times with the Ukraine war, and there was another kind of war, I believe in Korea, and this is when the S&P went down. But most of the time, the S&P has gone up. So if we have some kind of a recession or some kind of a higher oil price, it doesn't mean that the stock market will be going down. Now, what about natural gas? Qatar has even paused the natural gas facilities. They pretty much shut it down. It's the largest in the world. They expect it could take 2 weeks and another 2 weeks to bring it back online. And Iran is hitting kind of facilities in the Middle East related to natural gas, and it could spike the price of natural gas. I believe that could very well happen, but I believe it will most likely happen outside the United States than in the United States. In the United States, we have an abundance of gas. That's not the case in Europe, and that's why prices in Europe are going up 50, 70, 80%. I'm not saying prices can go higher in the United States, but it's not going to be as bad for US companies as it is for other companies outside the United States. Now, there is a study that every $10 rally in crude oil, it could cause 20 basis points of inflation. And if the experts are right, and inflation goes to, crude oil goes to $150 per share, we could be sitting at CPI inflation of about 4.3%. And the main concern is that the Fed can't really do anything about it. And that's what I'm going to talk about very, very soon. But the big elephant in the room, and this is by far the most misunderstood part in the market, is the whole thing about private credit. There's a lot of problems with private credit because they kind of skip the banks. They lend them directly to those companies, and they don't have to mark them on the markets until people start pulling their money out. Then they're going to have to sell those loans. Maybe they're not at 100 cents on the dollar, maybe for 80 or 85 cents on the dollar. And once you have this kind of bank run or kind of fund run where people are just running to take their money out, that could cause some disturbance in the system. This is 100% true. But if you look at this headline, it's like completely misleading. It says BlackRock just blocked investors from pulling their money out. The world's largest asset managers is telling people, no, You can't have your money back. This has never happened before. And this is an account with over 1 million people. Well, this is completely false. It has happened many times before. And I asked Grok about it because I kind of knew, but I wanted to confirm. But there's actually a pre-negotiated price cap. So if you're managing money, you have a fund, you're managing money for other people. So you kind of have some kind of limit where there's a 5 or 10-year contract where they have to be invested over the long term. And if you want to pull your money early, especially out of an illiquid asset, that's also the same with private equity and private companies and funds in general, there's some kind of a cap. So people don't go all in and they can't get out of something that's illiquid. There's a cap. Sometimes it's 5%, sometimes it's 10%. Well, this time it was a 5% quarterly redemption and they hit the 5%. So they didn't tell the people that you can't have your money. It would just hit the cap of 5%. But this is not what this tweet says. It's kind of sounds to me like it's the end of the world. And of course, those kind of tweets get a lot of attention. They scare some people away. Yes, there's some problems. I could say there's some concerns in private credit in general. But again, this kind of headlines are misleading. And it happened with Blue Owl. And Blue Owl was able to sell those loans at 98 cents on the dollar. Not for 70 or 60 cents, 98 cents on the dollar. And they had buyers within 2 to 3 days. So maybe it's not as bad as a lot of people are saying. Now, I believe in something that's really important, and this is a saying in the market. It says, don't fight the Fed. I believe it 100%. I believe in not fighting the Fed, but I also believe in not fighting Uncle Sam or not fighting the government going into an election on November 3rd when this party that's in power is expected to lose. Do I really want to bet on that? For me, I really don't want to do that. But the main kind of concern, again, is that the Fed and the government, they can't do anything about what is really happening because now we have unemployment, people are losing jobs, but at the same time, we could have higher inflation from a rising oil price, like I showed you in this chart. So that means the Fed is handcuffed, the government is handcuffed, they can't raise rates because we're losing jobs, but they also can't cut rates because of potential inflationary pressures. So they can't really do anything, and the stock market's gonna crash, and we're gonna have a financial crisis, and they can't really save private credit. This is another false statement, and we have seen it play out in SVB, Silicon Valley Bank, in 2023. The Fed's balance sheet has spiked up in a major way. They don't have to cut interest rates. The balance sheet of the Fed is much more powerful than the Fed itself cutting interest rates. And if they were willing to bail out SVB and inject about $800 billion in the system in 2023, when we had CPI inflation about 5.5%, don't you think they're going to do it now at 2.1%? Or even with the worst case scenario on oil prices, 1 month of 4% inflation? You don't think they're going to save private credit? You don't think they're going to be saving some things in the economy that could potentially happen? I think they will. And if you're betting on that, you're pretty much betting against the government, betting against the Fed. And that's not something that I like to do. So again, not a lot of people are talking about it. You look at all those headlines and everything is bearish. There's nothing, there's no floor, there's no puts. But I'm personally not seeing that. And I'm trying to give you the other side of the trade. And even right now, Powell is putting in $14 billion a week because, again, there's some illiquidity in the system, mainly in reverse repo. It's pretty much drained almost close to zero. So if they're doing it now and they did it at 5% inflation, you know, since they're going to do it at 2% inflation, you know, so to me, again, it's really funny. But the government has a lot of tools that maybe we don't know about. Even as the Treasury Secretary, he's announcing measures as soon as Thursday to combat rising energy prices that includes using oil futures market. So maybe they're going to be shorting oil in the futures market. Maybe they're going to be doing something else. But again, they have a lot of tricks. And if you're betting on oil remaining at $150 a barrel, if you're betting on a massive recession and financial crisis going into a midterm year when this party is going to do everything possible to keep things afloat and to even make things better going into November as they are expecting to lose, you're pretty much betting against the Fed and you're pretty much betting against the government. And they still have, of course, a strategic petroleum reserve and many different things that they could use. Now, in my last video, I said the stock market crash is nearing the end. And most people don't watch the whole video so they don't understand what I said. They assume that I'm saying that the market has bottomed today. I said we are entering the final stage of this market. And most people misunderstood the final stage. The final stage is pretty much here in the red circle, where most stocks, most correlations, they go to one, including gold, including oil stocks, including Verizon, including Coca-Cola, including GE Vernova and Bloom Energy, and all the energy leaders that were going up, they're starting to go down. And most of those stocks will follow each other's, and they're going to likely be going down together into the final phase where we have panic and we have capitulation and you have people selling the bottom because they believe this time is different, it's going to get worse, and we're going to have a financial crisis and all these kind of things that happen every time near bottoms. And this is when the VIX potentially hits 40, which is where we bottomed on the tariffs, where we bottomed on DeepSeek, where we bottomed on COVID, where we bottomed on GFC, and we bottomed on dot-com bubble. Now we're trading at 29, and we're getting very, very close. So this is what I mean by the final phase. I don't mean that the market has bottomed, but I believe the slow drain, slow chop up and down, and things getting forever, I believe that's nearing the end, and the next few weeks will likely be volatile, and I think we'll be done with it. And my main bet, and I told you guys before what I told you I had put options on QQQ, and I have a 10% cash position, and I still have the cash position. My main bet is that the NASDAQ revisits the previous high at around 540 on QQQ, which is only 8% from here. I mean, 8% is really not a lot. We could have 2 to 3 days of 2 to 3% and be done with this entire pullback. But my bet is I don't believe it's just gonna, like for example, just keep on going for the next few months, up and down, up and I believe this is like right now we're kind of nearing the end. This is my bet. We tend to revisit the previous highs in previous markets. Whenever we pull back, we revisit the previous high. I believe it's gonna be the same thing this time around potentially, and we're gonna revisit the previous high at 540. And I have those puts. If I'm right, they're going to be going up 500%. Then I use the cash to buy other stocks and other stocks on my watch list. But this is my thesis on the market. If we go under 540, then I could say I was wrong. Like if we go to, I don't know, 460, I'm saying, okay, I was wrong. But if we go there and we kind of bottom around 540, then I was potentially be right. And I don't like to take sides on the equation like many YouTubers like to say, oh, it could happen, but this and this. So they're never wrong. I bet on those things. I put my money where my mouth is. And I've been betting on this for a few months actually. And we'll see if I'm right or wrong. But that's my opinion on the market. That's my opinion on what's happening right now. If you'd like to join me in my group when I'm buying something, selling something, options and other things, I show everything I do in real time. And this is the link if you're interested. But thank you again for watching. Not financial advice. And I hope you enjoyed it. And I'll talk to you in another video.